Okay, so good afternoon. My name is Alex Murray. I'm head of real assets, as has been suggested at PREQIN's Research Insights team. It's a pleasure to have the opportunity to speak here today. So you can scan the QR code up on the slide here, and that'll get you access to these slides. And I'll show that at the end as well. I'll briefly take us through a show of our latest global fundraising and AUM forecasts, and then I'll dive into some slides helping place the Middle East within global alternatives. So we've been working really hard over the last few years to help improve the coverage of the region within our data. So I'm keen to show you some of that. I'll then finish with some investor sentiments, comparisons between global investor surveys and a survey earlier this year from peers in the region. So for those of you who aren't familiar with who PREQIN are, we're the leading provider of data and insights on the alternatives industry with a growing global presence. We're celebrating our 20th anniversary this year, having opened a Dubai office a few years ago. So we recently released our latest alternatives forecasts in our Future of Alternatives report. As you can see, we're forecasting 2023 to close out with a slower rate of fundraising compared to the last 2 years. This is more in line with the pre-pandemic pace. The pandemic delivered a hit to global fundraising in 2020. Fiscal and monetary policies were quickly enacted to stimulate economies in developed markets particularly, and this fueled frantic fundraising and deal making in 2021 particularly, with spillovers into 2022. Overheating of the real economy stoked inflation, as we're all aware. Central banks have since delivered the largest and fastest credit tightening cycle for many decades in an attempt to regain credibility after their dismissal of early inflationary signals as being transitory. Coupled with denominator effects from 2022, which saw 60-40 portfolios fall 17%, higher rates have continued to dampen some investors' appetite for alternatives. With rates increasingly expected to be higher for longer, the near-term forecast suggests global fundraising won't return to 2021 levels until 2028. That said, there are upsides to this forecast if inflation tempers quicker and rates are able to moderate. In the meantime, increasing appetite for private debt asset class, finding itself on the right side of tighter monetary environments, is proving alternatives are able to offer a variety of strategies throughout the business cycle. Despite this short-term reduction in the pace of fundraising, AUM is forecast to continue to grow at a slower rate across private capital, reflecting both this weaker fundraising environment and tempered performance in light of these higher interest rates. Across the asset classes, we forecast performance in funds targeting North America to drop from 13.5% between 2016 and 2022 to 12.2% between the end of 2022 and 2028. We forecast a larger drop for Europe-focused funds, decreasing from 13.2% to 10.1% over the same timeframe. Regardless of these challenges, alternatives have become a key part of institutional investors' strategic asset allocations over the last decade, and we don't expect that to change. The growth of retail investment in the sector may help cushion any pullback from institutional investors. For further insight on these forecasts and other topics, please engage with myself and colleagues to access our Insights Plus institutional research subscription. Okay, so I want to run through a few sections that will help understand the region's place within global alternatives with some benchmarking against global peers on the investor side. So, as was alluded to in earlier sessions today, it's far less clear where the Middle East currently is in the global market cycle. You can see here the views of investors where they thought we were at across the various business cycles. On the left are the results from the Global Investors Survey in June this year, while on the right you can see the responses from our Middle East Investor Survey from February. As is apparent, while the consensus from global investors sort of coalesces around starting to decline or approaching the bottom across these various market cycles, views on where the Middle East was at earlier in this year are far more diverse. While half of regional investors report macroeconomic markets being in a rising market, views of investors in the region on the real estate market suggest the Middle East might be following global markets as higher rates start to bite. 37% responded their view that real estate in the region is approaching its peak, and 43% suggest it was at its peak. However, favourable demographics, particularly high employment to population ratios in the UAE, well above high income and OECD benchmarks, may deliver a stronger demand side scenario for the residential and retail sectors. Further, the region has and continues to benefit from higher energy prices, aiding oil revenues and helping governments rebalance budgets. So these inflows have allowed sovereign wealth funds in the region to grow, supporting their global relevance. The chart on the left here uses PREQIN's comprehensive investor database to show the breakdown in aggregate portfolio AUM for investors in the region, alongside those globally. While only 5% of global investor capital lies within sovereign wealth funds, this stands at 34% for the Middle East investor capital base. On the right here, you can see the growth of sovereign wealth funds portfolios globally, analysed in our recent sovereign wealth fund report. The green section shows the portion taken by those here in the region. PREQIN tracked the portfolio AUM of the specific group at $3.7 billion as at March 2023, up 19% from the beginning of 2021. So that stands at 36% of global sovereign wealth fund capital. The line shows the share taken by these investors, with strong growth seen between 2013 and 2018 to reach a peak of 41% of global capital. As the amount of capital managed by Middle East-based sovereign wealth funds far exceeds the capacity of the region's capital markets, their appetite for global alternatives assets has risen. PREQIN analysis of Middle East-based sovereign wealth fund data shows that the average allocation to alternatives doubled recently, rising from 22% of total assets in 2021 to 44% in 2022. This increase reflects the flexibility that sovereign wealth funds in the region have, with fewer shorter and medium-term liabilities than other types of institutional investors. So PREQIN holds information on investors' strategic asset allocations gathered from public sources to inform their profiles on our data platform. We can see here the breakdown for two prominent investors in the Middle East, contrasting the allocations to alternatives in each. The Abu Dhabi Investment Authority has 19% allocation to alternatives, dominated by a 10% towards private equity, 5% in real estate, and the remainder between hedge funds and infrastructure. Market turmoil in 2022 may have increased ADIA's exposure to alternatives by default as public market corrections fed through the denominator effect. This could curtail medium-term ambitions to increase alternatives exposures further, though given the wide bandings used by ADIA for target allocations, some discretion will remain. For Middle East sovereign wealth funds, US real estate is the preferred market owing to stability, security, and growth. For example, ADIA has recently raised its North America real estate weighting to between 45 to 60%. In contrast, to ADIA, Mubadala has much higher allocation to alternatives. As a younger organization with a core remit to help diversify Abu Dhabi's domestic economy, this higher 67% allocation to alternatives reflects the more recent emergence of these models. Turning back to ADIA briefly, up until 2012, ADIA's deal exposure was predominantly towards buyout, while 2013 saw its focus shift more towards venture capital assets. More recently, it has embraced co-investments and direct routes to market, illustrating greater sophistication in the building of its alternatives exposures. They have sought to streamline internal processes, including a move towards a single investment pool within their alternatives investment department. So moving to look at a few insights on the growth of alternatives managers in the region. On the left here, you can see the annual establishment of new managers based on their location. The industry growth has been most active in UAE and Saudi Arabia, with UAE-based managers accounting for the majority of new managers, so that's the green line against the secondary axis. There was some earlier growth noticeable in Bahrain and more recently Oman. 2018 stands clear as the most active year for the establishment of new managers. On the right, we focus on the primary strategy of new fund managers within private equity and venture capital. As is clear, the vast majority have chosen to focus on venture capital strategies, particularly in the post-global financial crisis, before which growth and buyout strategies dominated. This is a signal of alternative models in the region are playing in helping diversify economies by channeling capital into earlier stage companies. So we can see on the left here the growth in the number of active GPs in leading markets over the last 5 years between 2018 and 2023. The doubling of managers in both the UAE and Saudi Arabia have contributed to strong increases in assets under management on the right here, rising from $22 billion at the end of 2018 to $45 billion at the end of 2022. The last 2 years have witnessed increased performance, underpinning growth in unrealized value, as well as rising dry powder, which as of the end of last year stood at 30% of AUM. This is in line with the share seen in more established alternatives markets. As a region that has been able to sidestep much of the worst macroeconomic headwinds in recent years, the performance of local managers is more likely to escape some of the downside risks materializing elsewhere across global alternatives. A quick look at venture capital deals in the region over recent quarters reveals the high weighting of the software sector. So that's the black section of the bars on the left, as well as financial services and internet deals. This is in line with what we see globally across the asset class. While there has been a slowdown in deals in the last 2 quarters, the software sector has shown resilience, growing its share of activity in the Middle East. Infrastructure deals have kept pace, despite interest rates rising from replication of monetary policy in the United States to maintain currency pegs in the region. Primary deals have consistently remained at odds with the global asset class, where we've seen primary deals contract as more operational assets increasingly rotate between established portfolios. The dominance of primary deals in the region attests to the expanding economic development of the region, seeing the creation of new assets to add to the capacity of growing national networks. Okay, moving on to our final section now. I'll contrast with some findings between PREQIN's Global Investor Survey from June and results from our Middle East Investor Survey from earlier in the year. So this slide puts side by side responses from whether recent performance of alternatives portfolios in each asset class lived up to expectations. So you can see on the left, a higher share of global investors tended to report returns having met expectations across the various asset classes compared to Middle East investors. So this is the pink section in the middle of the bars. Hedge funds stand clear as the asset class with the highest share of investors for whom expectations were not met, both for global investors at 40%, as well as those in the Middle East at 55%. Note also the generally lower level of Middle Eastern investors reporting performance having exceeded expectations. So this is the blue section at the top. While this no doubt reflects some difference in the exposure to underlying assets, its consistency across the asset classes in all but infrastructure suggests the return expectations for investors in the region are quite different. Investors in this region may have become more accustomed to higher returns from exposure to more favorable opportunities in recent years against global peers. Looking more broadly at current allocations in the region, we see private equity and real estate dominating, with 53 and 41% of investors citing 20% or higher allocations to these asset classes respectively. So this is the green sections at the top of the bars on the left. These higher private equity allocations reflect both the asset class's high weight in alternatives generally, as well as regional investors' higher appetite for alternatives. On the popularity of real estate, this partly stems from, of course, the fast developing sector here, and on a related point, the role the sector has played in helping generate the wealth behind many single and multi-family office investors. In terms of changing appetites for alternatives, amongst regional investors, venture capital has seemingly fallen out of favour of Middle Eastern investors between our 2022 survey and responses from this year. This reflects the direction of global investors with a broader move towards risk-off positions. On the other side of the risk spectrum, real assets are now in favour as a means to deliver inflation protection and cash yields as the prospects of lingering inflation continue. Okay, so looking forward at the short-term commitment intentions of investors at the global level, only venture capital and real estate witness a larger share reporting intentions to commit less capital versus more. Infrastructure and private debt stand clear as the asset classes attracting the largest net intentions to commit more, even if these have yet to translate into increased fundraising. So far in 2023, the global infrastructure asset class has seen the weakest fundraising market for at least 5 years by some way. Our quarterly reporting, however, showed a recent resurgence in interim capital raisings, feeding some anticipation of a stronger Q4 globally. Middle East investors report being generally more bearish than global peers, with a larger share planning to reduce short-term commitments across all asset classes other than private equity. So this is the blue section for the chart on the right. Further, lower shares of Middle East investors report intentions to maintain commitments at the same level compared to global investors. Put another way, regional investors seem more decisive in terms of their evolving strategic asset allocations towards alternatives. Just some key takeaways now to summarize. So globally, we've seen this tightening credit markets reflected weaker fundraising across alternatives, with investors becoming more cautious in light of falling public markets in 2022. And you can see that in our fundraising forecasts. The Middle East, however, seems to have mainly avoided many of these macro headwinds so far. Revenues from higher energy prices have aided sovereign wealth funds in pursuit of their economic development and diversification ambitions. Compared to global peers, investors in the region seem less satisfied with recent performance of their alternative portfolios. Finally, investors here seem more decisive in their short-term commitment strategies towards alternatives, with higher shares of survey respondents planning to change their commitment targets, both increasing and decreasing compared to global peers. Excuse me. Okay, well that's enough from me. Thank you for your time and attention. If you'd like to access these slides, please scan the QR code here. I hope you're able to garner some insights at both the global and the Middle East regional level there. I'll be milling around the conference, so please don't hesitate to catch me for a chat on any of these findings, or to discuss the broader data and research offering here at PREQIN, the home of alternatives. Enjoy the rest of the conference.
Alex, I'd like to have you on stage.
Yeah, sure.
Because we have some time for questions, actually, while we get our next panel ready. Do we have any questions from the audience? From the plethora of information that we shared? Great, I'll get a mic to you.
Yeah. So PREQIN, we tend to focus on closed-ended fund structures within the asset classes of private equity, venture capital, private debt, hedge funds, real estate, infrastructure, and a small part of natural resources.
Start in case he's
So
not
that's the
here.
breadth
I
of
think we
asset
just
classes
walk
that
up on stage and
encompass
do it.
alternatives. We sometimes use the term private capital. That's alternatives minus hedge funds, because hedge funds are a bit different. Not cryptos, no, we don't currently cover cryptocurrencies. They are, of course, relatively new but growing, but it's not something that PREQIN currently track.
I think, did I see his hand on that table? No? Okay, I'll get a mic too.
Thank you so much. Great presentation.
Thank you.
Question, and try to understand this here that in the Middle East region, there's a lot greater preference from especially some of the sovereign wealth funds to actually have more syndicated transactions, right, or deal by deal participation rather than lot more participation in blind pool funds. Is that something you've seen in any of your surveys, or I guess that's all clubbed together in your analysis?
So we track deals in our company intelligence platform, and where the information we can gather that, we would track the consortium, and we would garner information about who was coming in alongside. But I presume in a situation like that, it would be more in a direct route to market capacity rather than via a fund. And as you saw on the slide from Adia, we track when investors do direct deals for privately held portfolio companies.
So, the question really was, have you seen or have you heard from your surveys, is there a greater preference for that in the region in particular?
In the Middle East region, it's not something I've tracked in the numbers myself, but it's something we can certainly look into after the session. We can take that up with our local researchers. We have a team based in the Middle East area. It's something we can pick up.
Thank you.
Thank you. One last question.
Well, I attend late. If you covered this already, I apologize. Any PE or VC fund focusing on new energy in this region? Clean energy?
Focusing on energy?
Clean energy.
Oh, clean energy. I mean, specifically within the region or globally?
In the region, Middle
Within
East.
the region, there will certainly be some funds in there. I mean, a lot of the infrastructure funds that are raised in the region might look to deploy outside of the Middle East, and of course, that's what some managers here prefer to do. What we've seen, though, is a lot of foreign direct capital coming in via deals on ADNOC and add gas into the established national utilities. But in terms of funds specifically in this market, we can take that offline and do a search for that.
So there is no big solar farms, wind farms in the region?
In Saudi, you've seen a big take up in solar over the past 4 or 5 years. They've more than quadrupled their capacity in that 4 years. In terms of how much of that has been delivered by private funds, we can certainly look at. Some of it will have been done, by corporates on balance sheets. Some of it might have been done by state entities as well.
All right, thank you.
Thank you.